What's up everybody, GenExDividendInvestor here. In this video I'll explain what types of dividend stocks are better in taxable accounts versus what types are better for retirement accounts. So if you appreciate me making this for you and you aren't an evil troll, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Before I jump into what stocks go where, I'll open this with a relevant question, which is this. Is it even worth it to invest in a retirement account if someone intends to retire early? That's a fair question because some people understandably don't like the fact that they would get hit with a penalty if they wanted to withdraw money early from a retirement account. But my generic answer is still yes, it is worth investing in a retirement account like a Roth, even if you want to retire early, because life happens and what you plan to do doesn't always play out like you think it will. A key point to realize is that having a strong retirement portfolio can allow for decades of tax-free compounding, which is very powerful. And then if you have a Roth, you can also have tax-free withdrawals once you hit the appropriate retirement age. What I'll tell my kids to do once they have a real job is to number one, invest in your work 401k, at least up to the amount that your employer will match, and ideally more. Number two, max out a personal Roth, if you can. And number three, invest as much as you have left over to invest into a taxable account. Anyways, you can still probably do fine if you choose to only invest in a taxable account, though it means that you'll most likely end up owing more in taxes each year, which in turn will act as a drag on your overall returns, a drag which magnifies as the years go on. Thus, I'd recommend you invest in both rather than either or. Let's do an example to see how a portfolio's growth could compare in a taxable account versus a retirement account to understand the drag that taxes can have. Let's say you started with a $10,000 portfolio in a retirement account and you invested $100 a month for 30 years and you got a 10% per year return. You would end at an account value of $424,000. But now let's say you paid 10% in taxes each year, so instead you got a 9% per year return in a taxable account. That might come from taxes on dividends or sometimes selling a stock or whatever. Well, then you would end up with a portfolio worth $330,000. That means that only a 10% tax on your annual returns results in you having a portfolio that is 22% smaller over that time frame. But beyond that, once you hit retirement age and start doing withdrawals from your Roth, they would be tax-free. I think most of us estimate that taxes will be higher in the future, so the tax implications of a Roth are even more compelling. Granted, taxes on qualified dividends in taxable accounts are better than wage income, and can be zero at a federal level if you don't have other income. But regardless, I hope you see why I advocate for Roths and why I'll tell my kids to maximize them if they can, even if they have aspirations of retiring early. Anyways, if you're still thinking of only investing in a taxable account, then I recommend that you look at yourself in the mirror and make sure that you're someone who has enough self-control to not sell your portfolio when that cool new Xbox comes out. What I mean is that taxable accounts make it easy to buy and sell and transfer cash out, whereas the 10% penalty to early withdrawals that retirement accounts have often prevents people from cashing out early. Bottom line, you gotta prepare for your future starting now, as you never know what your tomorrow will be. A very powerful saying to reflect on is, this too shall pass. If you're in a really tough spot, just remember, this too shall pass. If you're doing awesome and everything is going your way, then also remember, this too shall pass. Please invest more during your good times, as that will help even out your bad times. So don't spend your annual bonus on that cool watch or expensive shoes, just invest it. I unfortunately know of too many people who kept putting off saving and investing for their futures, and eventually they came to regret it. One awesome thing about dividend investing is that each share you acquire pushes you down a better financial path, whether you're starting from zero or starting from $1 million. So don't fret if you're behind the 8 ball of investing, just start going down that better path. Okay, so my favorite type of dividend stock to hold in a taxable account are those that have qualified dividends, because they get lower long-term capital gains rates, which are often at 0%, 15%, or 20% depending on your income. Watch my video called How You Make More with Dividends, where I show you how you can make over $100,000 a year of qualified dividends as a married couple and not owe anything in federal taxes. Gotta love those qualified dividends. On the other hand, ordinary non-qualified dividends are taxed at standard federal income tax rates, which range from 10% all the way up to 37% for 2022. Note I'm keeping state income taxes out of this discussion, but you might have to deal with those as well. So what makes a dividend qualified? Well, there are 3 main criteria that have to be met. Number 1, the dividend must have been paid out by a US company or a qualifying foreign company. Number 2, the dividends are not listed with the IRS as those that do not qualify. And number 3, you must have had the dividend paying stock for at least 61 days during the 121-day period, beginning 60 days before the ex-dividend date. So generically, I'll just say that qualified dividends are dividends of common stocks bought on US stock exchanges and held by the investor for at least 60 days, which means they are qualified for the lower taxation rate. Almost all of my stocks are qualified. Special one-time dividends are considered unqualified. Also, qualified dividends must come from shares that are not associated with hedging, such as those used for short sales, puts, and call options. Realty Income, my real estate investment trust, aka REIT, has dividends that are not treated as qualified dividends and are instead classified as ordinary income, which is taxable at my marginal tax rate, which is one reason why I prefer to hold REITs in retirement accounts. But the recent Tax Cut and Jobs Act, aka TCJA, reduced the effective top marginal rate on ordinary REIT dividends from 39.5% down to 29.6%, and it allows you to deduct up to 20% of ordinary REIT dividends. So now holding REITs in a taxable account might make more sense. Note, I've not personally done the math nor talked to my accountant about this, so I'll always talk to a professional before taking a YouTuber's video as accurate. Beyond that, realize that it's possible that some portion of a REIT's dividends can be qualified and some can be considered a return on capital. Return on capital, aka ROC, occurs when an investor receives a portion of their original investment that is not considered income or capital gains from the investment. Note that a return on capital reduces your adjusted cost basis. Or to say that differently, ROC basically means that they're handing back to you some of the money that you invested with them, and since it's your money, you don't get taxed on it right then. For example, let's say you invest $100 into an asset, i.e. you hand someone 100 $1 bills, and then the people who manage that asset give you $1 monthly distributions, which they treat as return on capital. So basically they're just handing back one of your dollars each month. Since you already paid taxes on those dollars that you originally handed them, and which they are now handing back, you don't get taxed on them again. But it also lowers your cost basis as you get distributions as return on capital, and that means that if you ever sell those shares, you would have larger taxable gains. Okay, so we covered where REITs should go, but what about MLPs, aka Master Limited Partnerships? Popular MLPs include companies like Enterprise Products Partners, Energy Transfer, and Magellan Midstream Partners, and are known for having a higher yield, but their dividends or distributions aren't qualified. Common advice says that it's usually a good idea to hold MLPs in a taxable account instead of a retirement account, because there are some potentially unfavorable tax consequences to doing so. IRAs are subject to taxes on a special type of income called Unrelated Business Taxable Income, or UBTI, and the distributions paid by MLPs are likely to be considered UBTI. If a Roth IRA earns $1,000 or more of UBTI annually, the UBTI income above $1,000 is subject to tax even if the securities are held in a retirement account, which is typically non-taxed. So if your retirement account earns $1,000 or more per year in UBTI, you have just eliminated that tax advantage of that stock being in your retirement account. One way to get around that may be to invest in ETFs that have MLPs and some other things in them, as then you probably don't have to worry about UBTI. If you do want to buy MLPs, then realize you are actually buying units in your brokerage, not shares, which is why you become a unit holder and not a shareholder. And instead of dividends, you get distributions, which are treated as return on capital. If you decide to sell your MLP units, then you'll pay taxes based on the difference between the sales price and your adjusted cost basis, which was changed due to your distributions and potentially other things. Thus, selling can result in both a capital gain and an ordinary income gain for you. If you hold an MLP for long enough and gotten enough distributions, then your basis could eventually reach zero, and once that happens, any future MLP distributions are treated as capital gains in the year in which they are received, which is still better than ordinary income taxation. Finally, if you own MLPs, then you get to deal with K-1 schedules at tax time to figure out how much was capital gains or ordinary income or whatever, all of which can complicate your taxes. But hey, you get all that sweet income, so you can figure out what makes sense for you. Okay, another type of stock that I'd rather hold in my taxable account than in my retirement accounts are international dividend stocks, because if you hold most international stocks in retirement accounts, you might face up to a loss of 35% from international tax withholdings with no way to get it back. Watch my video called European Dividend Aristocrats where I explain all that. Canada is an exception to the rule for retirement accounts because the 15% withholding tax that is normally imposed by Canada towards Americans is waived when Canadian securities are held within US retirement accounts. And if you do choose to own international stocks in your taxable account, make sure to look into any potential tax withholding issues before you buy. Okay, so my high-level strategy is to usually hold my qualified dividend stocks in both taxable and retirement accounts. Now that I'm actually retired and using dividends to pay all my bills, I've stopped contributing to retirement accounts and instead only invest in my taxable. The younger you are, the more I'd focus on investing in companies and industries that you think can keep growing. Thus, tech probably makes more sense than oil. You can still make money in oil, but I bet over the long run that tech will outperform. What about high yield stocks? Is it better to hold a high yield stock in a taxable or in a retirement account if it's a normal qualified dividend stock? Well, again, that depends on your needs and goals. If you need income now or soon, then holding it in your taxable account makes sense. Just realize that if you have a job, then as you get dividends in a taxable account, you'll probably owe some taxes on them, so factor that into your decision making. So what are the other types of things that you take into consideration as you're evaluating where to put your stock? Well, if you think tax rates will keep getting worse and that you might be in a higher tax bracket in retirement, then using a Roth would make even more sense. The more tax inefficient your asset is, the more you want to figure out how you can optimize your taxes. The longer you can keep your assets invested and untouched, the more tax deferral or avoidance accounts should be used, and in general you probably need to invest for at least 10 years to really see the value. Here's a nice chart from Fidelity which shows you which assets are appropriate for the different types of brokerage accounts. On the left are the types of assets like stocks or ETFs or REITs or whatever. Then the middle column tells you some federal US tax info for those assets. Then the remaining three columns are the types of brokerage accounts that are appropriate to hold the asset in. So standard brokerage taxable accounts, tax-deferred retirement accounts like traditional IRAs and 401ks, and then tax-exempt retirement accounts like Roths. They put a dark checkmark based on which account it's more appropriate to hold the asset in, a lighter blue checkmark for accounts it's still okay to hold the asset in, and finally a light gray checkmark for accounts that are generally less appropriate to hold the asset in. So tax-free municipal securities and municipal mutual funds are exempt from taxes and are more appropriate to hold in taxable accounts, and are less appropriate for tax-deferred retirement accounts or in tax-free retirement accounts. Equity securities, aka stocks that are held long-term for growth, are taxed at long-term capital gains rates and are more appropriate in a taxable account, though are still appropriate in tax-deferred and tax-exempt accounts. Equity index funds and ETFs other than REITs are taxed at long-term capital gains rates and are more appropriate in a taxable account, though are still appropriate in tax-deferred and in tax-exempt accounts. Tax-managed mutual funds and managed accounts are taxed at long-term capital gains and are more appropriate for taxable accounts and less appropriate for other account types. Real estate investment trusts are next, and it says generally 80% of income is taxed at ordinary rates, 20% is tax-exempt, and are appropriate to hold in taxable accounts, but are more appropriate to hold in retirement accounts. Then we have high turnover stock mutual funds that deliver effectively all returns with short-term capital gains, and those are taxed at ordinary income rates and are less appropriate for taxable and are more appropriate for retirement accounts. And finally we have fully taxable bonds and bond funds, i.e. corporate bonds, which are taxed at ordinary income rates and are less appropriate for taxable accounts and are more appropriate for retirement accounts. Okay, so what about income funds like JEPI or QILD? Well, I'm guessing you're in them because you want the income now, so I'd personally hold them in a taxable. If you didn't need the income now, then I'd probably look to stocks which you think have great growth potential. Regardless, think about all your needs before firing off that stock buy. Like if you plan to hold a stock for less than a year, then using a retirement account can be nice to avoid dealing with taxes. But if you are holding for less than a year because you might need access to the cash, then a taxable account makes more sense. Though ask yourself if you should really be buying a stock when you know you'll need the cash in such a short time. Anyways, hopefully this all helps you when figuring out what stocks go where in your portfolio. Speaking of portfolios, M1 Brokerage has a promotion running for a free $50 cash bonus for new users. The way it works is you click on my M1 referral link in the description of this video, and then either open a brokerage account and fund it with $100, or open a retirement account and fund it with $500. Then you need to keep your money inside the new account for 30 days from the date of deposit to get the free referral cash. Make sure to check the details before you sign up to see what they're offering when you watch this video. Okay, now I'd like to do a shout out of a Patreon of mine named Crowmag27 who tagged me on Instagram with this picture of my mug that he bought on Teespring. I gotta say I like his setup, so thanks for buying my mug, Crowmag. And if you made it this far in the video, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Finally, I highly recommend that you join my free Dividend Discord chat server, which has thousands of dividend investors on it and is growing all the time. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.